Hello everyone, it is Evan from the Trade Risk here on Sunday, December 20th with a weekend market recap. It's going to be a little more consolidated in today's video. We're just going to focus on the major indices and a few other markets. We're not going to get into individual names or trade ideas in this video. Hopefully I can get some ideas out later this evening in the day on the stream, so keep an eye out for that. So we're going to focus on the market. We'll start here with the SPY ETF, and there's a few things to point out. One, the SPY ETF had an ex-dividend this week on Friday, actually. So by about $1, I think about 60 basis points or so was the effect of the dividend. So if you look at the cash market, you can see we're not quite as bearish as the SPY ETF looks. We haven't really taken out the previous Monday's lows, whereas the SPY basically looks like we're exactly retesting them right now. The other big piece of information, the big piece of news out, the Fed raises interest rates. We did a video on this on Wednesday immediately following that decision, and we were talking about the market rallying on that news. That was this Wednesday here. That was the last time we had an update. The market closed really strong. It had a 3-day push, and then it rolled right back over in the next 2 days back to the Monday lows. Now, on Friday, we also did have, I believe we did, quadruple witching, which essentially means we had a lot of options expiring on Friday, and typically, occasionally on those days leading up to them, you can have some pretty violent moves as the market sort of races to levels at which would expire the majority of those options. So you can take from that whatever you would like, but perhaps 200 was the mark that, you know, we had to get to in a pretty quick order in order to sort of inflict some pain and expire some options worthless. I don't pay too much attention to it, but I know a lot of people do, so take from that with whatever, you know, you sort of like. And let's focus on the price action now, because, you know, that's what I care about most. If you look at a weekly chart of what just happened this week, these are always, this week's candle is something that I really take notice of, is when you have these really large tails. I think that is generally pretty telling of a reversal or some type of, you know, week to take notice in this case, or, you know, just an area to take notice. We were rallying strong. We had, you know, I think north of 3% gains on the week by the close on Wednesday. Now, to completely unravel those gains in just 2 days, that's something that I take notice of. That means that there was a sharp move lower, and as I tell my members all the time, it's not how it starts, but it's how it finishes. I care about the closes on daily charts. I care about the closes on weekly charts. And when I see a close like this, that tells me that the bulls gave it a good try. They tried to get the rally going, but they couldn't seal the deal. There was too many sellers, aggressive sellers, waiting at those higher prices to drive us lower. Now, again, we could say the opposite happens. It's not 100%. Nothing's 100% guarantee that, you know, because we see this big topping tail, that means we're just going to trade lower next week. It doesn't have to mean that. Take a look at 2 weeks ago. Look at this very long bottoming tail here. We closed near the highs of the day, and in my mind, that was the same thought process. Well, the sellers tried to take control. They failed. Eager buyers down here rallied us to the highs. More often than not, I'm looking for continuation on that, and of course, we didn't see that. So again, nothing's foolproof, but I just want to show you, you know, this is collectively kind of when you analyze sort of this bar by bar analysis, you start to just sort of understand the sentiment and just some of the psychology of the market. And I think weeks like this are very important to take notice of. So if you go back to a daily chart, again, you got the ex-dividend here, but we are threatening to roll back over. Again, it is at a very interesting place. There's a lot of supply that price is sort of on this ledge of. Granted, this is a big level as well at 199, but really you don't want to see this market, if you're bullish, you don't want to see this market heading below this big 200 level. I think prices can move pretty quickly, and you can just sort of get lost in the mess down here. And I think it's just going to make it very difficult for the bulls to recover from that. So I think, where we close today, we definitely want to see us more or less try and hold this level into the end of the year. Now, on the positive side, the technicals look pretty poor here, right? Fast moving averages racing lower, on the verge of a breakdown, completely, could not hold on to the gains from this week. Those are all very negative things. The one slight bullish thing, and I know I'm reaching here, is that we do have some slight positive bullish divergence here in the advanced decline line cumulative reading. And again, it is reaching a little bit. I don't want to make a big deal out of it, but I think it's worth pointing out because it is pretty obvious as we start to pull back here. But take a look at this chart. So the top pane here is the cumulative, so it's summizing all of the NYSE advancing issues versus the declining issues. So you can see here the number is pretty irrelevant, but on Monday, on the lows on Monday, we had a reading of around 48,000. So if you look down here, that was, back on this bar back here. Now look, as we've pulled all the way back, we're not quite there, but as we've basically pulled back and retraced all the way back to Monday's lows, the market's back at the lows, and look where the NYSE advanced decline line is. The cumulative measure here is still positively diverging, as it's only at about a 30% retrace. So what does that mean? That basically means there are more stocks holding up than there were on Monday. There are more stocks that are advancing, that are trying to hold on to gains or making small gains than there were on Monday. So that type of strengthening under the hood of the market is a net positive when you start to think about, price coming back to retest support. Will it hold? Will it break? Well, when you have more stocks that are holding up, typically that means more that the likelihood of holding support is greater. Now again, nothing is 100%. This isn't this is just sort of a 1 week reading. We definitely want to see how this holds up and plays out going forward, but it is a small sort of eye catcher just to notice what's going on there. And again, you want to notice sort of the extremes, if this is really positively diverging or if it's negatively diverging. Like if this reading were already down here at 46,000, then you'd be a lot more concerned. You'd say, well, on the sell-off, the majority of stocks are just going to hell. We're probably in store for lower prices. Can give you a slight more bullish or bearish tone when you start to look at some of these internal readings. So again, take from that what you will. I think you certainly have a lot of bearish price action here. That's for sure. You got maybe some signs of bullish internals emerging, but it is still just way too early to really lean on that as your only bull case. So we just need to see what happens here going into the end of the year. Let's see if we can catch another oversold bounce, even though I don't think we are. We by all metrics, really, we aren't as oversold as we were, on Monday of this week, and that's what makes this close even more dangerous. So I think we've covered, pretty exhaustive here, the landscape. I think you need to be cautious. We do still have a very light long exposure on pretty much just our longer term holdings. We don't have any short term sort of long exposure on. We're not playing for a bounce. We're not trying to accumulate longs right here. We're still just playing defense, and we're going with some of our longer term names that have been working. Now, if we look at some of the other indices, the IWM, it's pretty much the same story. It's trapped in this range. It's coming back down to the lows from Monday. The small caps still aren't emerging or, doing anything sort of extraordinary. They're still just kind of sleeping. They're lagging, and they're just not interesting right here. The Qs, they're very similar to what the SPY looks like right now. We're back to this lower bounds. This will be, these have been effectively the leading index on the year, so we do want to keep this on watch to see if this shows any signs of breaking down prior to the SPY, or if it can start to rebound higher. But it is range bound, hasn't done a whole lot of damage, right? You could still argue that it's just consolidating here near highs, and we'll have to see if that does turn into a breakdown and turn us a little more bearish. But for now, trying to stay as objective as possible. It is still range bound until proven otherwise. Momentum's on the downside. Let's see if it continues into next week, or let's see if we can get another rebound here off of this 109 3/4 band. Now, if we look at some other indices, TLT, we'll start there, catching a bid, continued to work higher this week. Actually, it closed red on the week. I apologize, down to 43 basis points. I thought it eked out a gain. But look at where this was. So it's basically the exact inverse of what the markets did. Look at the nice bottoming tail here, starting to work its way back up to this 124.50 to 125 area of significant resistance that has been in place for some time. This is the range. We need to see this breakout of above 125 to get us more constructive on TLT. For now, it's still pretty range bound. Gold, this one's still hanging out. It's trying to hold on to these lows down here. Again, the story hasn't really changed. Back above 104 would get me more positive on the metals or on gold. Until it does that, I think you still just need to be cautious. Silver, similar situation. Need to get back above 13 3/4 to get a little more constructive. I think until then, you got to be you still have to be cautious there. USO continues in its downtrend, so nothing's changed here. Moving averages racing lower, downtrend still continues. Perhaps perhaps we need to get through the end of this year as people sell for tax reasons, and to not show the big losers on their book if they're trying to own USO. So perhaps January will be the next catalyst of calendar catalyst to turn this story around. But for now, USO definitely still in a void. Natural gas, same thing. This one's got killed all year, and I wouldn't want to be picking it up right now into the end just yet, unless you are trying to play for some type of January bounce effect. Then if that's your strategy, then certainly that could potentially work if you've proved it over time. And then finally, actually, I guess we'll just look at sectors really quick. There's really not much to talk about at all. Everything's getting beat up. The only two that sort of stand out are healthcare, which is still just basically range bound. You can see it's not, breaking lower yet. It's still trying to stay constructive as long as it stays above $70. Again, the placement of this isn't necessarily at highs, but it is tightening up in here, making it pretty actionable. So let's see if it can hang on there. If you look on the week, it actually closed up 27 basis points. So that is some relative outperformance. The only other sector, utilities, trying to hold it together, but still they're mostly just range bound, and lesser extent staples, even though they really got hit on this 2-day event. But they are still near the highs. Take a look at the weekly chart. The placement here is really nice. Still, you definitely want to see it hold this 49.25 level. Really needs to get back above $50.50 to start getting a lot more constructive. But the only slight standouts there, I would say, are those three. And that's all I have for this weekend video. A little bit shorter. As always, guys, thanks for watching. I will catch you next time.